All right, hello everybody. Welcome to today's webinar on the power of partnering. I'll be your host today, Jason DeBono, Vice President here at Newview Trust Company. I've been here going on 15 years, and one of the things that is near and dear to me is the power of partnering, because it's something that I've been able to use personally with my retirement accounts. We'll talk a little bit more about that as we go through it. But the goal today is to help everyone on today's webinar understand how exactly can an IRA make an investment with other parties? And we'll talk about what those parties may or can look like as we go through that today. Forgive me if I step forward here to the computer. It just allows me to see if there's questions. There is a chat functionality as well as a Q&A. If you do have questions as we go through that, please ask them. That will pop up on my screen. I'll be able to see that and get those read aloud and answered to the group. Due to the number of participants we have today, obviously we're unable to take questions via audio or it will get us slowed down a little bit too much. So thanks everybody for joining us. We certainly hope that you get what you're looking for out of today's event. And the goal again is really to help you understand, how does partnering work? What does it really mean? What are the rules? What are the landmines? And what are the things we have to do to stay within compliance while taking advantage of the ability to invest money alongside other parties? This comes up quite a bit, and partnering probably has the most opportunity with small balance accounts. Now, that's not to say that somebody with a larger account that maybe has enough money to make an investment may not choose to buy it alongside other investors, and we'll talk a little bit about why people may make that decision. But I'm going to go ahead and get us started, and we'll get right into it today. So what exactly is partnering, right? We use that term. Well, what exactly does partnering really mean? So the first thing is, it's buying fractional ownership. So it doesn't really matter what the asset class is, whether it be real estate, whether it be a promissory note. If you're buying a fractional interest in that asset, that would be considered partnering. And the reason is, you will own a piece, therefore somebody else or somebody's else will own the other fractional interests. And we'll talk through that with some case studies. A couple things to make sure that we understand. When you partner with an IRA, your fractional ownership is going to be dictated by the amount of money you bring to the table. There is no sweat equity. So if it's a $100,000 piece of real estate and my IRA has $25,000 that I'm bringing to the table, then I'm going to own 25% of that piece of real estate. I can't say, here's $25,000, but I own 50%, because that doesn't match the pro rata interest, money in, money out. So that's kind of the first thing that we need to make sure that we follow. As it relates to my pro rata interest, I, as the IRA, am responsible to make sure that the IRA pays 25% of any applicable expenses and collects 25% of any applicable income. So I cannot go out and buy a piece of real estate as a partner with 25% and then not pay any expenses, unless there's some sort of clear guidelines that dictate that, right? But it's very rare that you would ever see a scenario where that would be okay. So the typical way we approach it is, number one, money in equals your pro rata interest, dollar for dollar. Once you have your defined pro rata interest, the money has to flow in and out of that IRA per that same pro rata interest. The other thing to understand is that when it comes to IRAs, the IRS lists a group of disqualified parties. Now, some of you may or may not be familiar with that list. We're going to talk about that here on the next slide. But understand that partnering with disqualified parties is actually permissible. Granted, you need to follow some basic guidelines, and we'll talk a little bit about that. So when we talk about disqualified parties and we give the ability to buy a fractional interest alongside another party, and that party is someone considered disqualified. Disqualified parties in the eyes of the IRS per IRS code are you, your spouse, your parents and grandparents, your children and grandchildren, and the spouses and businesses majority owned by those parties. So for example, my IRA could not transact directly or indirectly with my spouse or my son or my father. And by extension, it couldn't operate, or I'm sorry, it couldn't invest directly or indirectly with any one of those parties' businesses that they were a majority owner of. Right? Those entities, by extension, become disqualified. However, we're not talking about an investment with, we're talking about an investment alongside. And there's an inherent difference between those two things. So when we talk about partnering, the rules of disqualified parties apply, but not in the same manner. So when we partner with disqualified parties, number one, money in, money out. So I'll give you just a quick illustration. I'm going to walk you through some case studies with you here in a bit. If my IRA is prohibited from, let's just say, loaning money to my spouse, we would all agree, clear transaction between two parties, and those parties are defined by IRS code as disqualified. The IRS says impermissible, prohibited. However, my IRA can go out and issue a loan to an unrelated party. There's no issues with that. So if I wanted to loan it to someone I just met, my IRA could do that. There's no disqualified party issue. And if that individual wanted to borrow $50,000, but my IRA only had $25,000, I could write 50% of that loan out of my IRA, and my spouse could write 50% of that loan out of her IRA. The reason that that is permissible, whereas transacting together is not, is we're merely owning the same asset. But we don't actually have shared ownership. We have clearly defined separated ownership on title. So it would be titled New View Trust for the benefit of Jason's IRA for 50%, and New View Trust for the benefit of Christina's IRA for 50%. So that shows the IRS that there's no money changing hands between myself and my spouse through our IRA accounts. Instead, I loan money to unrelated party through my IRA. My wife did the same thing, and that individual makes payments back to each of our IRAs respectively. Now, I use the example of 50-50. Understand it could be 70-30, 80-20, 90-10. It's dollar in, dollar out. So in that scenario, I couldn't put in $25,000 of the 50 and take 75% ownership. The math simply doesn't work. That would be a prohibited transaction. Furthermore, when it comes time to make those payments, if that borrower is paying $100 per month, $50 has to go back to my IRA, $50 to my spouse's IRA. If I take all $100 to my IRA, I've now taken money that belongs to my spouse's IRA, and now I've gone from being alongside, which is permissible, to money moving hands across those lines or between those parties, which is prohibited. So make sure if you're going to partner with disqualified parties that you are clear money in, money out. Second item is, it's important to know that you're drawing a line in the sand in permanent marker. So on title, if I own half in my IRA and my spouse owns half in her IRA, or even her personal money, it really doesn't matter, I could not down the road decide to change the ownership and buy her out or vice versa. So I can never come to her and say, hey, you don't want to own this anymore, here's 25 grand, I'll buy the other half of that note. That's prohibited because that's no longer a transaction alongside each other, that's a transaction between disqualified parties. So when we partner with disqualified parties, understand that we're setting a little bit more firm boundaries, whereas if my IRA were to go issue that loan alongside a non-disqualified party, so an example of that could be same loan, $50,000, and my IRA is going to put in $20,000, and a friend of mine is going to put in personally $30,000. No issues there, and because that friend of mine is not considered a disqualified party, over time, I could choose to buy out his $30,000 interest in that investment because that transaction would be between non-disqualified parties. So if you're going to partner with unrelated parties, you have a little bit more flexibility. If you're going to partner with prohibited parties or disqualified parties, then you have to be very clear about what you do from day one through the life of that. The second piece of a transaction is it needs to be arm's length. So at no matter what deal you do with an IRA, it has to be at what the IRS considers arm's length at market terms. So if there's some ancillary benefit that you or a disqualified party gets by making the investment, it may be prohibited. So understand, just because you partner doesn't mean there's no rules of disqualification. It simply means that the act of buying alongside a disqualified party in and of itself is not disqualified, but the transaction as a whole still has to meet the standards of being arm's length to not violate any IRS rules. Additionally, if an IRA has any interest in an investment, by extension, that investment becomes prohibited. So a couple examples where we see this, very common in real estate. If my IRA goes out and buys a piece of property, I am prohibited from providing sweat equity, so doing repairs, etc. I'm also prohibited, so are all the disqualified parties, from living, staying in, or using that property. If my IRA buys 20% of a property and an unrelated party buys 80%, I still am prohibited as if my IRA owned 100% of that property. So I cannot go and stay there 80% of the time or stay in 80% of the property because that's owned by a non-disqualified party. If your IRA participates in any asset, it is universally considered a disqualified asset going forward. So this isn't a way to buy with someone and be able to use the property half the time or pay half the rent. If you own any percentage in an IRA, all disqualifications apply to the ongoing ownership of that asset. So something else to be mindful of. The last piece of this is when you partner with a disqualified party, obtaining a loan becomes more difficult. So I'm not going to go too deep into the weeds on that, but understand that if you buy a piece of real estate with a disqualified party, you cannot obtain traditional non-recourse financing because the loan itself has to be split between each of you separately. You cannot generally, as a general rule, have one loan on that property. If you have questions on that, give our office a call. We can certainly talk through that. But I want to make sure that everyone understands that process. So I will pause there. I'm going to grab a little water. And it looks like we've got a couple questions coming through. So let me pause there and get those addressed. So the question is, can you loan to a spouse if it's under 50%? I don't know what that means in terms of whether or not you loan under 50%, but I'll answer the way I believe it means, and please modify that question again if I missed the mark. Your IRA can never loan money to a disqualified party. If you are on 1% of the loan document, meaning you only put in 1% of the money, or 49% or 100%. The percentage has nothing to do with whether or not disqualified parties exist. It has to do with whether or not money is changing hands between them. And there's a big difference between partnering, which is alongside, and investing with each other where money's changing from one party to the other. An example, if my IRA wanted to go out and buy shares of Microsoft, I could go out and my IRA could buy shares of Microsoft. My wife's IRA could also go out and buy shares of Microsoft. The fact that we own the same asset is not prohibited. It is titled separately, and on the next slide, I'm going to talk about titling and how that looks. That segregation of ownership by title makes it clear that we're simply buying into the same asset, not investing with each other. And as long as each party takes the appropriate money in and out based on their pro rata ownership, we're never doing business this way. We're simply doing business alongside each other. In the case of loaning money to a spouse, whether you're on the loan for 1% or 100%, that is your IRA's money going into the hands of your spouse. That is a transaction. Those parties are disqualified. Therefore, it's a prohibited transaction. So hopefully that addresses that in the manner that you were looking for. All right. I got a question that says, what is the proper way to use a trust when partnering multiple IRAs? And I will actually cover that on the very next slide. So we'll get to that here in just a second. So in putting all this together, the summary of this slide is really to help understand that rules of disqualification are put off to the side because you're not transacting together, you're transacting alongside each other. And that's really what makes it permissible. We always recommend consulting legal and tax advice, especially as you get into more unique type transactions where you have a bunch of different parties, because you want to make sure that you're looking at not just the purchase and whether or not that's disqualified. You always want to look at the overall ownership of that asset. So the litmus test of prohibited transactions is not one time, it's overall, because something that may not be disqualified at purchase could later become disqualified based on your behaviors, right? So make sure you're seeking some counsel as needed based on the transaction that you're looking to handle. Most of the transactions that we see with partnering are generally 1, 2, maybe 3 partners, tend to be family members, maybe a spouse, spouses both using accounts. The one thing that I want to make sure that I don't create any confusion on is there is no difference between IRA money and non-IRA money as it relates to disqualified parties. So what I mean by that is my IRA can buy a portion and my wife personally can buy a portion. Or my IRA can buy a portion, my wife's IRA can buy a portion, and my wife and I personally, as just personal money, can buy a portion. As long as it's clear on title, segregating the parties, that the money we put in is reflective of our pro rata ownership, and for the life of that investment, all the money that moves in and out of each of the respective accounts is done under the same pro rata split based on our ownership interest. As long as we maintain that throughout the life of that transaction, that's permissible. What would make that prohibited would be not following the appropriate percentages, trying to change percentages down the road. Those things become prohibited when investing alongside disqualified parties. The second thing I want to make sure doesn't get lost in the shuffle is the fact that there is no requirement on percentages. So it could be 90-10, 80-20, 70-30. I may use 50-50 as examples because it's easy math for me to do, but ultimately there's no requirement on the percentage. So long as you could make a case that there are other parties that could have stepped in and made that transaction, it's permissible. Well, that's a pretty easy case to make, right? I'm going to buy half, my IRA is going to buy half, my IRA is going to buy half, my wife's IRA is going to buy half. Well, I could easily go find another partner to buy that half. I didn't bring in my wife because she has her IRA because it's the only money or there was some ancillary benefit. I simply brought it in because it's someone I know that has money that wants to invest in that asset. But in theory, I could easily go get any other party that exists out in the world to invest alongside me. So that line in the sand helps make it clear that I don't need her money to make this deal happen. I simply chose for her money to be participating in this deal. And that's a big distinction. Let me pause there. I know this is a slide that may create lots of questions, so I want to make sure I'm getting them all. All right. All right, I'm going to read this one out. It's a pretty lengthy question, but let me read it. I had $50,000 in my 401k, but we were not married, and I loaned him $25,000, and he paid it back in 60 days. So I'm going to just pause there. So did a loan, got paid back, not married, non-disqualified, no issue there. So that was 2 years ago, and I consulted with my plan admin, and they said, okay. Now we are married, and I'm looking to use my IRA to purchase 4 flips in 2020 and wanted to be clear about my purchases. Maybe I should set up an appointment after the webinar. We can certainly talk about that. So let me go back to that question. The first part of, can you make an investment with someone when you're not married? And the answer is yes. They're not considered a disqualified party, right? Therefore, you can transact with them as long as it's arm's length. Now, if you wrote the loan to that individual at 2% when the market rate is 7 or 8 or whatever it may be, then the IRS wouldn't have an issue with it being a deliberate prohibited transaction by disqualified party. They would refer to that as a prohibited transaction by not being arm's length. The relationship caused you to give them a significant discount on that transaction. Therefore, they could have an issue. But if it was all at market rates, no issues. Once you're married, you can now no longer use that money to invest directly with your spouse. So you couldn't loan money to your spouse. You couldn't buy a piece of real estate that your spouse owns. Your IRA can't buy a piece of real estate and then hire your spouse, or not hire, but just have your spouse go in and do the work. There's no sweat equity allowed inside that. So you want to be cautious of that. And we can certainly talk through maybe some of the examples of what you're looking to to accomplish, and we can let you know if, in fact, it seems like there will be no issues. And I think it's important for everyone to understand our role. As custodian, we are 100% passive. It is a self-directed account. The onus of making investments and ensuring investments comply with the IRS is 100% on you as the account holder. We are here to help. We will answer your questions. We will talk you through. We tend to live our world in 3 different areas, right? One is where it's very obvious yes, it's very obvious no, and we'll be very clear on that. Based on what you told me, no. Based on what you told me, yes. There don't appear to be any issues. There will be an area where we will tell you you really need to consult with a tax professional, and it has to do with how close clients want to get to the flame. We, right, are not the judge and jury, nor are we the police or enforcement agency. So we will not book anything that we know or believe to be expressly prohibited. However, we also don't know once we wire money out, we don't know what the life of that investment is, and we don't know the behavior of the parties, nor could we. And that's why we don't certify or, guarantee that this is permissible or not permissible. But if you give us the information, tell us exactly what's going to transpire, we can point you sufficiently into the right direction, and at times that direction may be to seek legal counsel. And again, it has more to do with the fact that you are so close to the flame that you need to talk to someone, number one, that can do the appropriate interpretation of IRS guidelines and understand how or what risks may be exposed in the event that you go forward with that transaction, and that decision becomes yours. So when you start talking about some of these unique transactions, we love creative clients, but we want to make sure creative clients also understand the boundaries or have at least sought counsel to feel comfortable about the boundaries. We should never be relied on as the group to say, I can go do that because I told them a tad bit of information and they said okay. You need to make sure that you understand exactly the life of that investment, what is going to transpire, and make sure you're seeking counsel appropriately. So going back, this was a question earlier, and I want to talk about how this can be structured. So the first way that we see these types of partnering transactions structured is what we refer to as direct title. Direct title means that each partner is listed individually on one title. So if you're going to go buy a piece of real estate and let's just say it's my IRA and my son's ESA, it would be titled Newview Trust for the benefit of Jason's IRA for 25% and Newview Trust for the benefit of Tyler's ESA for 75%. That title would be on the warranty deed in the case of real estate, and it would be reflective and recorded as both owners right on title. Couple things that are important. Percentages have to be listed, right? You can't say Jason DeBono's IRA and Tyler DeBono's ESA without listing percentages, because then the IRS has no way to come in and confirm, in the event they were to review it, what you bought it in, what percentages, and have you maintain that percentage of ownership. Second thing is, once you go on title that way, if the partners are disqualified, you can't change ownership amongst each other. If the parties are not disqualified, then you have more flexibility in selling a piece or portion of your asset to one of the partners. You can always sell to unrelated third parties no matter who you partner with in a transaction. We typically see that direct title up to 4 parties. I can't say you can't go over that, but most title companies will probably have an issue if you try to extend that out. Would suggest you move into some sort of entity. As far as entities goes, I used an LLC example, but that entity could be a land trust, it could be a C corporation, a partnership. There's a variety of entity structures. So LLC is the most common, land trust probably the second most common. In this scenario, each individual that's investing into the LLC would buy a prorated interest in the LLC. So if the LLC was going to take a total of $100,000 in, every person would get a percentage based on what they put in. So if IRA 1 puts in 25%, IRA 2 25%, IRA or personal funds, 1 25%, personal funds 2 25%, and it could be 20, 40, 40, 20. Right? You can split up the pie however you want, as long as it's pro rata based on the dollars put in and out. In that scenario, from our standpoint as custodian, we will not own individual assets, we will simply own an interest in the LLC. So when you look at your statement at NewView, it will say IRA 1, 25% interest into ABC LLC. From there, the LLC will take title to the asset. So if it's going to issue a loan or it's going to buy a piece of real estate or whatever it's going to do, the LLC handles the individual investments. So rather than the title having 4 or 5 names, the title simply bears the LLC. And then the LLC has the record of how it's split up from there. Either way is fine with us. We don't have a preference. There are probably some reasons and rationale from an asset protection standpoint, ease of titling, not having to get a bunch of different signatures, why the LLC, the more parties you have, becomes more attractive. But that also comes with some additional responsibilities. We do not require you set up an entity. When you buy with multiple parties, that's a decision that you would want to make and understand the benefits to making that. So let's pause there. Let's see here. Anything else has come in? I just had a follow-up to the previous question. And it looks like we got someone that came through the chat. Someone mentioned that the slides don't seem to be advancing. So I am on slide 4. It says partnering structures. Hopefully that's what you see. If you don't, please let me know. But I don't believe that to be an issue externally, as I'm simply sharing my screen here. So I mentioned that partnering is near and dear to my heart, and it's the way that I've built my 401k, my health savings account. For those that don't know, you can use a health savings account to self-direct, so you can save money tied to a high-deductible health insurance plan, and then educational savings account. So we have an 8-year-old, and we've chosen to use an educational savings account to put money in, and that money can be used tax-free for qualifying educational expenses. So those accounts allow the flexibility to be invested. Now, the contribution limit on an ESA is only $2,000 per year. The contribution limit to my health savings account is for my plan as an individual plan is only a little over $3,000. So for those of you that are on this webinar that are saying, yeah, I love the idea of self-direction, but I've only got $4 grand or $2 grand or 10 grand. I'm going to show you some real examples of things that I have done over the years and exactly how they were structured and how they worked out from a standpoint of making returns into these accounts. So the first transaction that I want to talk about, this was simply a private loan. Now, this is the only loan, and I've done quite a bit over the last 14 years. This is the only loan I've ever done that was actually a primary residence for someone. This loan, if I recall, was like 2010, 11, and it was at a time when the mortgage crisis was going on, the Great Recession, real estate prices had really bottomed out to a point where there was properties people wanted to buy, but they couldn't go get financing. And maybe they lost a home and they couldn't go get public financing, or they simply couldn't get financing in general. This was a loan. Now, if you look at the loan amount of $126,000, I didn't have $126,000 in my account to write this loan. And if I did, I may not want to put it all into one loan. This was a property that contract price was $180,000, so you can see about $56,000 or $54,000 of equity in the property at depressed prices. It was a principal and interest loan, so their payments were both principal and interest, and it had a 5-year balloon at 13%. Now, if you notice, my 401k only bought 15.5% or $19,000 worth. However, if you go down to the bottom there, and I should say, I partnered with 2 unrelated parties. So these were people I met out in investment groups and associations that I got to know, that I simply partnered off with. We found this loan through a mortgage broker, a local mortgage broker in town that couldn't finance it, and so they referred it to us for private financing. This deal was 3 different parties. You can see 15.5%, 52.5%, and 32%. So we were all over the place. It wasn't round percentages. And this loan paid off in about 3.5 years. It was fantastic. If I could write, 20 of these, I certainly would. And my 401k collected $216.04 every month for 3.5 years. Now, there was some principal there, so it wasn't all earnings, but it was returning 13% per year. And it was a great deal because at $19,000, I didn't have a sizable 401k. I didn't have enough money. I hadn't been contributing to it very long, just a couple of years. So I needed to find something where I could still generate returns. So even though I only owned 15.5%, I still generated 13% return. And that was an awesome deal. As I continued to grow the balance of my account and look for other opportunities, I had an educational account for our son, and then I also had an HSA. So this example was a loan. We structured this through a land trust. It was set up at 15% interest, so it was a great loan. This ended up actually going on for 26 months, which was awesome, but it was in 1-year increments. So every time it renewed, so every 12-month period, there was a $500 fee to extend it. 16% in Tyler's educational account, 16% into my HSA, and 17,000 or 68% into my 401k. What was really cool about this, this was a deal, let's see, he was born in 2011. This deal was done in 2013. We contributed $2,000 for the current year, or sorry, for the previous year, and $2,000 for the current year at the same time. We did this in like March, I think, of 2013, if I recall, or 2012. And so we were able to put in $4,000 and turn around and invest it right away. Right? And that was the loan. You can see here the income, it may seem small, it was only $50 into the HSA and ESA, but that was only interest. There was no principal requirement. So that was all interest coming in, and $50, that's $600 per year. Right? So that was a great investment, and that allowed those accounts to continue to build up. You don't have to make a ton of money. $50 is a lot when you look at I only invested $4,000. So it was a 15% return. A land trust, but this time for equity position. So if you don't want to be on the lending side, you can actually own equity. This was a transaction that was 25% in Tyler's ESA. You can see the balance has continued to grow. Now it has $11,000. The 401k had $37,000. I didn't even need to bring in my HSA to do this deal. But I put in the equity for this, and it generated, the flip itself generated a return. It was a little over 12%. It was only 11 months, but it worked out to be a little over 12%. And you can see the numbers that came back. So a little over $1,300 of profit into the ESA and about $5,000 of profit into the 401k. These are examples of ways that you can deploy money. And if you notice, I did a deal that didn't have anyone I know, no disqualified parties. I've done a deal that was 3 parties, all disqualified parties. I've done deals that were 2 parties, disqualified parties. You can slice these things up however you'd like to. So let me pause there and let me take, I know a few questions have come in. So the question says, is there a way to keep the trust once formed? Money returns to the trust so that the trust can do another investment, and then how does the custodian track that? So great question. So the first part of that is if you set up a trust, I am not an expert in entities, so you'll want to talk to either the accountant, attorney, whomever it is that you would seek advice on in setting up an entity. An LLC I can speak to a little bit more intelligently. An LLC is not asset specific. So if you set up an LLC and you partnered into that LLC with multiple parties, even if they are related, all that's permissible, then that LLC can in turn make deals time and time again. So it can do a deal, money comes back to the LLC, it can do another deal, money comes back to the LLC, it can do another deal. As custodian, we don't track all the individual activities inside the LLC. That is not our responsibility. We simply track the LLC as one asset. Annually, the manager of that LLC will provide us an updated value and any accounting that they want us to keep track of. So we will update the value annually. So if I put in $50,000 into that LLC, and forget about other parties at this point, right? And my $50,000 has grown to $62,000. My statement once a year, or more frequently if the manager wants to report back to us, will now be reflective of my LLC interest at $62,000 instead of $50,000, and so on. And that would be unique to each IRA that we custody that happened to be invested into that LLC. As far as trusts go, if it's a asset-specific trust, then no, you cannot keep rolling it to different assets. But if a trust that allows you to hold assets in perpetuity or multiple assets, then certainly you could. So there's no requirement on the IRA side. You'd want to make sure the entity allowed what you wanted to do. All right, let's see. We've got some questions, and we're wrapping up, so now's a great time. It says, can I move my HSA for my employer's control in order to self-direct? As a general rule, yes. Your employer cannot require your HSA be held at an institution. They can, however, require that if they're going to make a matching contribution or put money in on your behalf, that they put it to a particular institution. So if they choose HSA Bank, which is a very common HSA company, if they choose HSA Bank to hold your HSA and they're going to put $1,000 in on your behalf, and you put in as much as you want up to your legal limit, once they make that, put that money in the account, you could turn around the next day and transfer your cash balance out. You'd want to keep that account open for future contributions from your employer, but they can't require that it be held at a particular institution. 401ks work much differently. It is a group plan, therefore they can control while you're an active employee where it sits. But under HSA provisions, you are not required to maintain it at an institution permanently. However, you may be required to accept their contributions through a particular institution. But again, the very next day you could transfer that over and self-direct it. I'll read this out. Someone may have to address this. It says, for smaller accounts, and it says each DOL costs money and I don't know what that means. I'm sorry, if somebody could fix that question, I'm happy to get that addressed. It says, do you have a network or bulletin board for potential partnership investments to help us find partners for smaller events? The short answer to that is we don't. As a passive custodian, we maintain a passive role. Therefore, we don't have an active way for people, to message individuals with message boards. The other thing, part of that is it would also put an influx of people trying for you to invest with them rather than partner. And it's something that if we open that up, it would probably be much more problematic than it would be worth. That said, we do have quarterly client networking events where we bring people together and let them network. If you decide that you want to meet someone there and partner with them, great. Those are mostly here in Central Florida. We have our annual Planning for Prosperity event. We just had over 200 people. That's an all-day symposium. That was last month, was a great event. That's another opportunity to meet people. We encourage, I can tell you what I did personally, depending on those that are in, what market you're in. I know a lot of you are spread throughout the U.S. There are local real estate investment clubs. They are called RIAs, R-E-I-A. There's a National RIA Association where you can find all the RIA members and clubs that may be in your local market. I would encourage you to go start there and do some networking. Obviously do due diligence before you partner with someone, but there's lots and lots of great people. The first deal I ever did, that partnership with two unrelated IRAs were two people I met through the investment club, unrelated to NewView. So there's some opportunity there. It says, where do you find the land trust deal opportunities for investing? Really the same question, similar answer. Finding deals in some ways is really hard and in some ways can be really easy. You can't find deals sitting behind a computer screen in most cases, and you can't find them on your couch. We recommend, again, if you want to find deals, go out to where people are putting deals together. Real estate investment clubs are just a great source because those tend to all be nonprofit associations that are educational in nature. And so the people there that are members are all looking to learn more or actively mentor, engage in the investment of real estate and real estate related opportunities such as lending. Those are great resources. Meetups, if you've not been to meetup.com, again, do due diligence, make sure that you're not just lending money to someone because they seem like a decent person. Every loan I've ever written in any of my accounts has always been secured, and it's always been secured by an asset that's worth more than the loan itself. All the real estate deals I've done, I've always had a third party that I work with that I knew that's done flips. I'm not an expert in that. They handle all the work. They had skin in the game. And so I'd encourage you to make sure that you're not just handing money over recklessly, that you're really understanding where those opportunities lie. But you got to get out to these groups, associations. There's real estate events in your backyard going on as we speak. A little bit of internet searching will help you find them. And then get out there and network, get to know people and ask some questions. So DOI is direction of investment. So for smaller accounts, each direction of investment can cost money what may be impactful to smaller accounts. So the short answer to that is yes, when you make an investment, there are fees. We, as a custodian, obviously, we don't work for free. Our fees are very fair, and they're very inexpensive for what you get. If you're, one of the things that we do, and this is something I've done in all my lending deals, is that any fees that I'm going to pay to write someone a loan are paid by the borrower. So there's opportunities when you're partnering or you're doing deals where you don't have to pay the fee directly, nor does the account. You can pass that on to the borrower. If they go borrow money from Bank of America is going to have a lender fee, right? I may charge them $100 to cover my fee. They're going to charge $500. So that's something you can negotiate into that. We can't help the fact that, you know, partnering a bunch of smaller fees may come at a cost, and that unfortunately is the reality. If your investment, if I go back and look, we charge a $95 transaction fee. For $95 for me to go generate an investment that makes $600 is still a good investment, right? And if you're fee conscious, then you may have to wait on the sidelines until you have enough money to absorb that fee. But I will tell you that fee pales in comparison. You're paying similar fees when you invest into stocks, bonds, and mutual funds. In fact, mutual funds have one of the highest fee ratios of any asset class that exists. So you're probably paying a lot more than you may think you are. Let me see here. I think I've addressed those. Let me just check and see if anyone asked any questions through the chat. And it looks like we got a couple that have come that way. The last question here, a couple people, you know, that are just with general comments, asked, how are payments collected and distributed to the various accounts? So I'll wrap up on this since we're past the 30 minutes. When you have an account where it's direct titling, meaning NewView has custody of one or two or three of the accounts that are on title, we will split the money between the accounts as directed, and we will send money out as directed for payments from each account. So if you have a property tax bill that's $1,000, we will send each prorated portion out of all the IRAs that we hold. We cannot handle, nor are we a property manager, for assets that we don't hold. So if there's 5 parties on a deal and 3 have accounts at NewView and 2 don't, then we'll manage the 3 based on your direction of what comes in and what goes out, but you'll have to handle the other 2 because they're not under our custody through whatever means possible. We do see a lot of people when they partner, especially with some IRAs and some non-IRAs, generally we have a property manager to collect the income, pay the expenses, and the property manager facilitates that. If it's done through an LLC or a land trust, then the manager of the entity would collect all the income, pay all the expenses, and then distribute out money to the appropriate parties pro rata. So a little bit easier and more flexible when you have more parties through an entity. But in a lot of cases, if we have like a husband and wife that buy a property together, issue a loan, 50-50, 70-30, again, it really doesn't matter, but they're the only 2 parties on title. We collect the check, we split it between the accounts, and we do that every month. If there's payments, they direct us to pay them, and then we simply pay them pro rata out of the accounts as well. Let me just make sure I've addressed everything through that process. I got all of those, and I don't see anything else coming through the chat. So I know we went over just a few minutes. It's a pretty exciting topic, and it can generate a lot of questions. I appreciate those of you that took the time to ask those. Those are important because I'm sure your question is somebody else's, and it helps us make sure we're clarifying all the stuff. We talk about this all the time. We recognize you may not be as familiar as we are. So we stand by ready to assist. Again, we'll answer questions as needed and help in any ways that we can. Our goal is to have as many people out taking advantage of all the opportunities self-direction affords. And if partnering is a way for you to take accounts that may not be able to self-direct otherwise, then it may represent a really good opportunity for you. So thank you very much for your time today, and we look forward to assisting you with all your self-direction needs in the future.